Hi, my name is Jim Parker, and this is my business partner, Carey Sobel, and this is Boss Talk, where we talk about selling businesses.
Today's episode is titled The Difference Between Main Street and M&A. Chances are you don't know what we're talking about. If you're a broker, you probably know what we're talking about. Main Street is a term that a lot of people don't know, but I think the majority of our audience has probably heard the term M&A before. So there is definitely a level of subjectivity in what the difference actually is, and there's no right or wrong reason to why somebody has that justification. But today we're going to talk about our perception of the difference between Main Street and M&A. And again, this Boss Talk series is about selling businesses. So there's big businesses, there's small businesses. That's the quickest way to look at the difference between Main Street and M&A. Main Street, from my perspective, is when you're essentially selling a job. There is a business owner that owns a business that is going to sell their business to another person who's going to be the business owner-operator of that business. Main Street, or M&A comparatively speaking, is larger transactions where typically somebody is going to buy the business for an investment standpoint, and maybe somebody else is going to run the business. So to me, the biggest thing is not necessarily the size of the business, but maybe who the buyer is going to be. Now, there is a threshold from a dollar standpoint that I have in my head. I typically use $3 million as the number where I think it's between Main Street and M&A. Jim, give your perspective on the difference between Main Street.
A lot of people in our industry, that sell businesses, whether they're M&A or Main Street, they look at it and there is that dollar amount that they have in their head. And I've heard so many times over the years that $1 million, anything that sells for under $1 million is considered Main Street. Anything over $1 million that'll sell for over $1 million is M&A. And I'm with you. I don't think it really comes down to a dollar amount as much as it comes down to who the most likely buyer of that business is. If it's an individual buyer, we're looking it's going to be a Main Street type deal.
Yeah.
And also the complexity of the business. And then if it's going to be more of an institution buyer or somebody that's going to be buying it from an investment standpoint where they're putting a manager in place or something like that, it's going to be M&A. But at the same time, I don't think that is necessarily cut and dry either to make that statement. Because sometimes you get an investor type buyer that is just they're a very well-off person and they want to acquire that business and they have a manager in mind that they want to put in that business, and that may not really be an M&A transaction.
Right.
And to me, again, you can't cut it off at the dollar amount.
Yeah.
And I kind of consider myself I don't consider myself a Main Street business broker. I don't consider myself an M&A advisor. I consider myself an upper Main Street business broker. I typically sell businesses that have gross sales between $1 million and $10 million. Now, in there, I do sometimes run that fine line where something is more of an M&A transaction, and that's okay. And then sometimes I look at that and go, this is definitely going to be an M&A transaction. It doesn't fit my wheelhouse, and I'll refer that on to an M&A advisor. Because it's really important, I feel like, to be successful in selling businesses, you have your own wheelhouse on how you operate. You got your systems and processes. What you do, what I do very, very well. And it's got to fit in that wheelhouse, though, or it's kind of like throwing a wrench in the gears, and it's getting all caught up. And it's not good for me. It's not good for the seller. It's not good for the buyer.
And when you and I are doing a deal and we do a listing, for example, we don't sit there and say, okay, is this M&A or is this Main Street?
Yeah.
We don't categorize that, but there are different things as you're going through the deal that have characteristics of an M&A transaction versus a Main Street transaction. Let's start with maybe the broker's role in it, right? Because you consider yourself upper Main Street, $1 million to $10 million. So
in gross sales.
In gross sales. So if we were talking about a dollar amount threshold, you play in both instances, right?
Yeah, right.
So
I could border that. I do Main Street. I can do the lower end M&A. Exactly.
And you, for example, you said you don't care to swim upstream as much more to go into larger M&A deals. I want to learn how to do a lot more M&A deals.
And you're getting really good at it.
It's fun.
I love my space.
Yes.
I love it.
It's challenging, right? Because, there's so many more complexities that become involved with an M&A transaction. And I think that the role of the broker or the intermediary changes. Mm-hmm. When you're working on large-scale deals, that are strictly M&A deals, and that from the beginning because maybe it's a $60 million transaction. you're typically seeing a lot of investment bankers involved.
Private equity groups.
Private equity groups are probably the only buyer because there's no individual buyer writing a check for that amount that's going to go run it themselves, right? So, all the aspects of the business being different, but you're seeing a lot more sophisticated professionals, international tax strategists and specific consultants for that industry. There's a massive solar listing business that my buddy has that he's looking to sell. It's going through an investment banker. He's had 5-6 different analysts run quality of earnings reports, things that you just don't see in a Main Street transaction.
Right.
So it's a completely different animal.
Yeah, the team on an M&A transaction could be a lot bigger than a team that a seller or buyer are going to have on a Main Street transaction. That's for sure.
So, I opened up saying that, Main Street, typically it's selling a job. And, it's not to discount somebody's business, that owns and runs the business, but the chances are the person that's going to come in to operate that business is another individual. It's another individual or business owner. And while they may not do the same job that previous buyer did, just who is going to be in charge of that business? That's a Main Street business.
Right. And that's how I look at it. When I'm looking at a business and I'm for a seller and I'm deciding, I'm coming up with a broker's opinion of value, the most probable selling price of that business. And I'm looking at it if, something that I want to take on myself. My perfect scenario that I love that business owner that may or may not have graduated high school, got out there in the real world, worked their butt off, ended up learning a lot, went on their own. It was just them working for a few years, just working a lot, and they slowly built a company. And you fast forward 25, 30 years later, and they built themselves a really good company. A really solid, blue collar type business. They got a few trucks on the road, maybe 5-10 trucks on the road, and they're looking, hey, I'm now ready to retire. I'm ready to move on from this venture. And then my buyers tend to be the opposite. My buyers tend to, be college graduates or have a graduate degree, and they have worked most of their life in the corporate world, and they've done really, really well for themselves. They've moved up. They're making a couple $100,000 or more in their job. They've got a decent net worth, and they've just done really good in their career. But they're in their 40s and 50s, and they're going,
what's next?
I've always dreamed about owning my own business, and I'm not getting any younger. And this is the time to do it. And they're looking to acquire a business. That is, and I don't want to say that that's my only type of seller I work with, and that's my only type of buyer I work with.
That's an ideal situation.
But to me, that's where I feel like I'm the strongest. I love that type of a situation. When I look at a business and I'm like, okay, the chances are that 95% chances is going to be a private equity group play, and it's a great business. It's not for me. It's just not what I like to do. The private equity groups are a lot different. It's all about, the financials. There's no emotion involved. Everything's analytical. It's just a totally different type of mentality than that person that is just dreamed about owning their own business, and they are bringing more emotion into buying that business and that passion that they have, and
feed off of
the opportunities that they're looking at and things that they're looking to do. I love that.
So I got to ask you a question in that scenario. That is an ideal scenario, and I guess you can call it like almost like a blue to white collar matchmaking of individual buyers. But let's say that business was an $8 million business, or the listing price, most probable selling price is $8 million, and you bring the business to market, and you don't know who the buyer is going to be, right? You don't know who's going to come across the listing. So if it's that individual that you talked about, white collar, worked in a corporate ladder, making good money, has net worth, and wants to now own a business, the buyer could also be a institutional private equity firm that's going to come in, grab the business, build it up for 3-4 years, and then flip it.
Right.
When you bring that to market, is it Main Street or is it M&A?
Yeah, and even if it be $8 million,
it doesn't matter.
It doesn't even $8 million. I could bring a business to the market that's $4 or $5 million. Yeah. Because typically, businesses that sell between $400,000 or $500,000 and $5 million, if it's an individual, they're getting an SBA loan.
Yes.
And that's kind of the play that I work in, is the businesses are going to sell for $1 million, $5 million. It's kind of my range as a sales price. And when you bring it to the market, and there's a business for $4 or $5 million, it could be that individual that's looking to buy the business and get an SBA loan. Or like you said, it could be a private equity group looking in to bring that on as either an add-on, meaning they have another type business that's similar to that and they're adding on to it, or they're venturing into that new business and it's a smaller private equity group. It could go either way. And in that kind of a situation, I have to look at it both different ways. And I'm good with that because we don't know which kind of buyer will buy it at that point. And so I'm coming up with an adjusted EBITDA number and a discretionary earnings number. We can get into that.
Let's
later.
get into that next.
Yeah, we'll get into that later. But it's bordering that sometimes when you're getting to the $3, $4, $5 million.
But it goes to show that it also doesn't matter from a broker standpoint because you're going to run point, facilitating that deal the same way.
Yeah.
At the point where a buyer comes in and it is a more institutional type buyer, the process of getting the deal done will have more characteristics of an M&A deal.
Right.
Versus if that buyer that comes in and it's the individual will probably be run in more of a Main Street. So does that make sense?
Yeah, no,
I don't
it
know
does.
if that makes sense.
No, it does. And I just want to say too, what's great about Boss Group is that we've got a huge database of buyers that are individual buyers looking to acquire businesses. Mm-hmm. And that's probably a huge selling point for us and using our services. But we also have access to thousands and thousands of private equity groups as well. So we can put our foot in both sandboxes, to say. And that's what's really nice. And when you're dealing with a business that kind of teeters on that it could be a private equity group or it could be an individual buyer, we can play in both of those.
So we've come to the conclusion at this point that the biggest difference between Main Street and M&A transaction is really who the buyer is. And there's certain aspects of the deals where the characteristics of what you do or how you do it is a little bit different. So one of those is valuation, right? So you just mentioned discretionary earnings and adjusted EBITDA. So a Main Street transaction is typically going to be sold at a multiplier of the discretionary earnings of a business. Whereas if a institutional buyer in an M&A type transaction, they don't really look at discretionary earnings as much as they do adjusted EBITDA. EBITDA, earnings before interest, taxes, depreciation, and amortization. Now, the multipliers that you use for discretionary earnings versus adjusted EBITDA are a little bit different, right?
Yep.
But there is a pretty fine line of who the buyer is and what they're going to look at. So when I recast financial statements, I almost always, if it's a business, at least a couple $1 million in gross sales, I'm going to provide a DE number and I'm going to provide an EBITDA number. And when I have those numbers at the bottom, I have a different set of multipliers for each, so that if a private equity group is looking at it or an individual buyer is looking at it, I have entertained both of their interests in how they're going to value the business.
Right, and maybe this is a good opportunity that we dive deeper into what is discretionary earnings and how that's different than adjusted EBITDA.
Yep.
So we're going to do this really, really quick. So I can't.
You need a whiteboard or something.
Yeah, this is going to be very, very quick and very, very basic. But basically, discretionary earnings, or DE, what you're doing is you're taking the net profit of the financials, whether it's the business tax return or the profit and loss statement, and you're adding back numbers to that into the net profit, and that's what's going to equal the discretionary earnings. So you take net profit plus owner's salary plus depreciation, which is a non-cash expense, plus amortization expenses, because that's a non-cash expense, interest expense, because the seller's going to be paying off all loans at the closing table and the buyer would not have to pay those loans. They may have their own loan. And then any discretionary expenses, meaning any expenses that are not truly needed for the business, and then one-time expenses. You put 2 air conditioners on your roof last year and it cost you $20,000. That's not likely to happen for the next 15, 20 years.
Right.
So we can add that back. And then any benefits that the seller's getting from the business directly, whether it's their health insurance or some kind of retirement program, and you add all that up, and that's what the discretionary earnings is. And it's really important to do those adjustments and those add backs to come up with the discretionary earnings, because like when I'm instructing new brokers, I always ask, one of the first things these are brand new brokers, I always say, if you're looking at a business that's making negative $20,000 bottom line, is it a good business or a bad business? And newbies would be like, well, they're losing $20,000. It must be a bad business. And that's not necessarily the case. And that's why we're making those adjustments. We're trying to unwind the tax advantages that the CPA and the seller are doing to reduce their tax advantages to come up with what a new person could make from that business if it continues to be run the same way that it is right now. And that's what the discretionary earnings is. Now, adjusted EBITDA, that is almost the same thing as discretionary earnings. And like Carey said, EBITDA stands for earnings before interest, tax, depreciation, and amortization. And then we put adjusted in front of that because we're making the same exact adjustments that we are for discretionary earnings, except for we might be adding back the owner's salary, but we're injecting a salary in there for a manager to operate that business, and that's a fair market salary, because that type of buyer is the type of buyer that the buyer's going to be looking at the adjusted EBITDA is the type of buyer that's an investor that's going to be buying that business, and they're going to be putting a manager in there. So that's really the difference between the two, is that owner's salary in there. Now, please, when you're looking at all those numbers, and if you're a business owner and you're trying to do those add backs yourself, you got to be very, very careful, because I could spend probably another hour and a half just talking about the owner's compensation portion of that and all the what ifs, ands, and buts about it. So, that's why you got to talk to an experienced broker. But that's the biggest thing. To boil it down, that's the biggest thing. Carey, you were mentioning that about the multipliers. And so what we're doing at that point, once we have the discretionary earnings number or the adjusted EBITDA number, and like Carey said, sometimes we're going to have both numbers. Now we're going to databases. We have about 4 or 5 different databases that we go to, and we see what types of the same type of business. Let me rephrase that. The same industry as a subject business, and approximately the same size, what they've sold for. So you might bring up 15, 20, 30 businesses in that same industry, approximately the same gross sales, how much they sold for. We're seeing that multiplier that was used or was divided from gross sales, seeing what that is for the adjusted net, the adjusted EBITDA or the discretionary earnings, and that's how we're applying that price. And so for an adjusted EBITDA, that multiplier is usually higher, and on the discretionary earnings, that number is usually lower. And the reason is because the owner's compensation is being included in the discretionary earnings, which is driving up that multiplier.
Exactly.
The adjusted EBITDA doesn't. But then there's other things that may or may not be included, whether it's a M&A deal or a Main Street deal. And that is also why those multipliers are a little bit different. And we're going to get into that. But those multipliers, if you do it kind of right, they're kind of show at the same price at the end of the day. Yeah. So as a business owner, you'd be like, wow, I want to do an EBITDA number because I'm going to get a higher price, or I want to do a discretionary earnings because I'm going to get a better price. It's really going to come down close. It's going to be about the same price.
Yeah, that was a really, really good explanation.
Well, thank you.
And it was quick enough to where I think the audience will understand what you talked about.
Well, good.
And I couldn't have summed it up better myself. Nice work.
All right, thank you, buddy.
And it's funny because when I first got into the space, I had no clue that Main Street or M&A were even categories, and still to this point it isn't as relevant in what we do. It's just about the way that we go about doing it. But now every time I'm recasting financials, every time I'm looking at it, I always put myself in the buyer's shoes. And if you look at an institutional, more sophisticated buyer, I think another thing that we always see is the level of add backs and the level of things that you see on a Main Street business is usually a little bit more bloated than you would see on like an M&A deal, right? So when an institutional buyer, huge private equity company, comes in and they look at how somebody's running their business, they may not give the credit for some of the things that would be added back
on a Main Street business.
On a Main Street business for discretionary earnings. So, the easiest way for me to wrap my head around it was, if you're running your own business and it's maybe a little bit of a smaller business, discretionary, it is up to the seller, their discretion, the owner of the business, to run their books the way that they want to run their books. Right. So you're kind of looking for, them running it more like maybe a lifestyle business, whereas, somebody who's positioning their business to sell a little bit more upstream to M&A, those books are usually pretty squeaky clean.
Yeah.
Maybe a little bit more so sometimes than.
But there's just less add backs usually all the way around in the up and M&A situation.
They're larger businesses, and it's a more sophisticated seller.
Right.
More sophisticated seller.
Yeah, and going to the the difference between M&A and Main Street is not just the type of buyer, but the complexity of the business, and how complex that business is. And, also the bigger the business is, the more infrastructure that business has. I don't sell businesses anymore. I did it years and years ago to sell for $100,000. There's usually hardly any infrastructure in those type of businesses. The business owner does everything themselves, and it's just very simple operation, and there's nothing written down. And then as you grow, you're having more employees, you're having more support staff, you're having more systems and processes in place, and it's becoming more and more of a complex type business. And then you get to a point where you're selling a business for $30-40 million. You've got a company that's got a lot of the I's dotted and the T's crossed.
So is it fair to say that in M&A transactions, comparatively speaking to Main Street businesses, timing is different? Takes a little bit more time to get an M&A deal done?
Yeah. So exactly. And the complexities.
Because of the complexities.
And the complexities involved in actually selling the business is a lot more. You got that bigger team that we were talking about.
That's right.
But there's also a lot more complexity. So a true M&A advisor, and I've got a lot of great friends that do M&A transactions for 40, 50, 60, $100 million. They don't do that many transactions.
Yeah.
They might, depending on how big it is, they might do one deal, or they might do 3 or 4 deals a year. Whereas a small Main Street, a business broker doing small Main Street deals, they might be doing 20 deals a year, 25 deals a year.
Yeah.
And then there's people like us, the upper Main Street business brokers that are kind of in between those two. But the complexities and the time involved for every transaction, the bigger the business it is, the more complexities that are involved in getting that done.
I realize that we also didn't define M&A. Yeah. So M&A means merger and acquisitions. And I think an easy way to look at this too is a lot of bigger businesses or groups that own a series of businesses, they look to find a way to add value to their existing businesses. So let's look at the word merger. You may acquire a business or merge with a business to make your business better. That's an M&A deal. So if you got a business that manufactures widgets, and in their widgets they have a part that they outsource, right, to build their widgets. If they then merge with a company or acquire a company that manufactures that material for the part in their widgets,
vertical integration.
It's a vertical integration. It's a strategic acquisition, and those are typically M&A deals, right? That person manufacturing the part that owns that business, I'm just going to assume it's probably a decent business if they own all this equipment to manufacture something. So just a basic example of M&A, merger and acquisition, being a larger scale deal, and it's an investment most of the time. It's not, I'm going to go buy a job. That is not a Main Street transaction. So that's a decent illustration to show the difference.
And once it's under contract, think about that. A business that's selling for $100,000, you get it under contract, it's probably going to close in 30 days. The spaces that we tend to work in, you're usually looking at 90 days because you've got SBA loans involved. In true M&A transactions, really big ones, it could take 6 months to a year or longer to make that transaction go through. So you're looking at a much more training period. Maybe we could talk a little bit about what's included and not included in the two different transactions.
Okay. So in a lot of M&A deals, you do see a lot of stock sales, comparatively speaking.
Yeah.
So, but I don't know if that's relevant to your question. What's included, typically is, the furniture, fixtures, and equipment,
right,
and the assets of the business, the goodwill of the business, the inventory, and then, where it starts to change a little bit is accounts receivable, working capital.
Yeah.
So in an M&A transaction, and even some of our upper Main Street transactions, working capital becomes a huge point of negotiation.
Yep, it does.
Accounts receivable does as well.
Does. And, in a Main Street transaction, usually, just to sum up what Carey was saying, is the seller's going to keep the cash that's in the bank.
Oh, good point.
They're going to the inventory is going to be sold. The seller is going to pay off all the loans. They're going to pay off all the accounts payable that are due all the way up until the day of closing that they incurred, even if those came in post-closing. And they would receive all the accounts receivable for all the work that they billed all the way up until closing. even if that's received after closing. And then inventory is usually included. So that's kind of sums up like a Main Street deal. And then you get into the M&A transactions. Oh, let me go back to the Main Street. Usually when it comes to working capital, you're looking at a situation where the working capital is not coming with the business. Again, the seller is keeping the cash in the bank. They're keeping the accounts receivable. They're paying off the accounts. They're keeping the accounts receivable. They're paying off the accounts payable. They are giving over the inventory, but there's no working capital. And the working capital is usually coming from the SBA lender, and they're building that into the deal, and that's what they're using for working capital. When you're looking at an M&A transaction, you're looking at a different situation where accounts receivable could be given all to the buyer, or a portion of it given to the buyer. There might even be negotiations on keeping the cash in the bank, or portions of the cash in the bank to the buyer. Accounts payable is all negotiated. So all that kind of stuff, it's more open-ended in an M&A transaction. And obviously you can look at it from a seller's perspective in a discretionary earnings situation. In a Main Street transaction, that it benefits the seller more because they are keeping the cash in the bank. They're keeping the AR, but you also got to look at those multipliers.
Yeah, the multiplier is going to be bigger on an M&A deal, so that's why everything changes. And it's all about pulling the different levers. At the end of the day, the characteristics of both of these are so different, and it does become so much more complex on M&A deals, especially when you talk about due diligence and the different layers of financing that you see in some of these M&A deals. There's always almost some type of corporate financing or private equity stock issuance. You see like a lot of different
ways the business is going to be financed.
Yeah.
And we're in the upper Main Street world where we work. It's usually an SBA loan. If it's a smaller transaction, for $100,000, $200,000, it's probably an all-cash deal or some seller financing. And then you move into the private equity group world or the M&A transaction world, and they're that's not being done by a bank loan. It's investors that are coming forward and investing in that private equity group.
So, do you see a lot of M&A deals where there is seller owner financing? It's usually in the form of like a standby note or an earn-out.
You can see it as an earn-out, and that's the whole thing. You start going down that road as well, is that the deal structure could be a lot different, because you could be looking at earn-outs, where, the seller is going to get monies if this happens or that happens. You could have a situation where there might be a little bit of owner financing. There could be rollover equity where
Let's explain that.
Rollover equity, where the seller, like I sold a business, about 2 years ago, where the seller got some rollover equity. The buyer had already, it was a group of buyers. They owned I don't want to say what kind of business it is because it's a very specific business, but they had a business that was very, very similar to my seller's business. And so they were acquiring the seller's business, and then they gave some equity in the transaction of the whole entire company back to the seller. So in that case scenario, the seller got, and I forget how much he got in rollover equity, but let's say that 90% he got paid in cash, and then he got 10% in rollover equity. That could end up years down the road being a second bite of the apple for the seller. So that when they sell that business, he's got equity in that. He's got a second bite of the apple, and who knows? He might get it was a he in this point. He may get more money that second time it's sold than he did the first time, because this company's really trying to grow the business. They're trying to acquire a lot of those types of businesses.
And it's really advantageous for private equity groups or large institutional buyers when they're acquiring a business to offer rollover equity to the seller of an existing business, because it's almost like an insurance policy, right? If that business owner is running their business for 20 years and then they get bought out, and they roll over some equity, the larger company that's acquiring them wants that person that knows how to run the business to continue to do it, while that larger company finds out the ways to get economies of scale and buying power and ways that they can actually help support and grow the business they acquired. And then a lot of times it's also advantageous for the seller that rolls over the equity, because now they're getting this larger group that's in most cases larger than their business, that gives them the extra horsepower they need to really grow that business. And instead of getting maybe a $5 million exit at closing, maybe you get a $4 million exit, and you take that $1 million and throw it back into the deal, and now you have a chance to turn that additional $1 million that you held back into $10 million because you didn't have that infrastructure, Mr. Seller, yourself when you were running your business. So that is the way that it can be turned into a mutually beneficial way where it provides insurance to the buying entity, and the seller entity can actually recognize a much larger transaction value than they would have if they didn't roll it over.
And in the scenario that I was talking about, that wasn't a private equity group. That was a strategic buyer. They're already in the industry. But the private equity groups, maybe we can touch a little bit on the private equity groups and explain to the audience kind of what a private equity group might look like. And so you have a private equity group. They'll have investors that'll say, okay, when we come, they're going to do a call, and they'll have all these investors that might say, hey, you bring forward a good business, we'll chip in $150,000 towards that, and they might have a bunch of investors. And when they go to their investors and say, hey, we identified a business, we want to move forward with that business, they're going to do a call where those people have to put that money up. And if they don't, then they're kicked out of the group. So they collect all that money, and then they're acquiring a business. And so typically what happens in a private equity group space is that they might buy a business for $4 or $5 million. And they're coming in with, usually like we were talking about, they have somebody that's going to manage that particular office. There's not going to be an owner-operator there, but they're bringing in the know-how to scale that business. They might be taking a lot of the profit that's made from the business plus additional monies to scale that business. And what they're typically trying to do, and I don't want to talk for every private equity group out there because everybody's a little bit different, they're trying to grow that business as much as they can. And they might spend it, grow that business for 5 years or 7 years, and then they're selling it to a bigger private equity group that's coming in and doing the same thing. Now they're putting their infrastructure in place. They're funding it. They're trying to grow that business again, make it even bigger, and then it's sold to another private equity group, and it kind of moves up the scale.
Yep.
So just like in our world, we have Main Street business brokers, and then we call ourselves upper Main Street business brokers, and then you got M&A advisors, and there's M&A advisors from all different sizes, going all the way up. It's the same thing in the private equity group world. It's you got small private equity groups that acquire smaller businesses, and then there's ones that acquire a little bit bigger than that, and they go all the way up.
And their goal is to grow. So
that's where they're making their money for their investors. Yeah. Is when they turn around and they go sell, for the most part.
And that illustration you gave was like a startup private equity company, right? But let's say they did that 4, 5, 6 times, and they're building a portfolio of businesses that are all similar in the same industry. They're growing their private equity group in a space. And
they might be doing a roll-up in the industry, like HVAC right now.
Huge
HVAC's going through a major roll-up right now. The multipliers on HVAC businesses have skyrocketed because we're trying to go. There's so many different entities out there, not just private equity groups, but so many entities out there that are they're buying up different HVAC businesses and putting them together and building it.
And the point of a roll-up, just to dive into it a little bit, is, and I have a buddy right now who's looking to buy an accounting practice, and
I've got one under contract right now.
I need to talk to you about that.
Yeah.
So he's trying to buy an accounting practice, and his idea is to do a roll-up in the accounting space. So what that means is he's going to acquire one business that's existing because he has no experience in the accounting space, but he likes it because it's there's some synergies with some other stuff that he does. So if he buys that first accounting business and gets grounded, he's appointing somebody to run the business for him, so it will be an adjusted EBITDA type of multiplier, as we talked about earlier. And his goal is to take the cash flow from that business to go buy another one. And then he's going to buy another one. And let's say these 3 integrate together. And now he went from a business that's doing a couple $1 million in revenue to $5-6 million in revenue. And then a couple years later, he buys a couple more. Now maybe he's got an accounting practice worth $15 to $20 million. His goal now is going to try to sell all of that roll-up to a larger group, probably a national accounting practice, to say, I have this book of business, I've rolled this up, I've integrated the systems, I have a great operator in here. That's the concept of what a roll-up is on a small scale.
Yeah, and that large national accounting practice may not have might look at that one practice that he's acquiring right now and go, it's too small.
Exactly.
It's too small. We're not interested in it. They want it to be a certain size. So rolling that up and buying all these different businesses and putting them together, then it starts to make it attractive to that national accounting practice. And I know we're getting a little off subject on this, but we were talking earlier about the multipliers and looking at businesses in the same industry in the same size and coming up and seeing what they sold for and coming up with that multiplier. This is a concept I think you need to understand as well if you're a buyer or even if you're a business owner and you want to grow your business through acquisitions, is that multiplier is going to, as the business size gets bigger, the multiplier gets bigger. And don't take these numbers. I mean, every industry is different. But let's go really, really small for a minute. A business is making $60,000 or $70,000. The multiplier might be 1.5. You get that up to $1 million. You might be looking at 3 or a little less or a little bit more than that. You get into something that's $2 million. That multiplier now might be up at 4 or 5. You know what I mean? Like, I don't want to take these numbers I'm just giving you an example. But those multiplier numbers get bigger as the business gets bigger. So when they go to sell, they might have bought this accounting practice for X amount of dollars.
2 times.
But by the time they get done acquiring 5 or 6 businesses like that, the multipliers that they paid for each one of those businesses was this. But when they go to sell, the multipliers will be like this for each one of those businesses.
And conceptually speaking, that identifies directly with roll-ups. That identifies directly with what most private equity companies.
That's what they're trying to do.
Yeah, and that is a great way to underline M&A versus Main Street.
Yeah.
It's a different concept. Now you could buy a Main Street business and turn it into something that M&A group or private equity groups are looking for. So a big difference.
Yeah, no, I was going to say, I just wanted to add on to that.
Yeah,
you
please.
go back to the scenario that I was talking about, that my perfect type buyer, my perfect type seller, and I sell more than that. I don't want you to think that, but like that kind of situation, you take that person that has just killed it. They went out in the workforce, they worked their butt off, they were smart, and they built that business into something really great over a 25-year period of time. And then you take that corporate buyer that has done really well in the corporate world, that's just dreamed of always owning their own business, and they acquire that business. They usually can implement things because of their background for 25 years in the corporate world. They can implement things into that business that allows them to kind of take it to the next level that makes it attractive to a private equity group type of situation.
100%. We were talking about this. You wrote down people coming down from a PE.
Oh my gosh, yes.
Buying themselves a business. So you want to
Yeah, no, I know.
I connected that dot.
Yeah, no, and this happens quite a bit to me, where I have a business for sale, and a buyer inquires on that business, and they're from the private equity world. They may have worked at a private equity group or whatever it is, and they're used to dealing with deals that are $50-60 million. Now they're looking at a $2 or $3 million business that they want to acquire, not for the private equity group, for themselves. And they're trying to apply the M&A transaction into what's really a Main Street deal. So I'm valuing that business on, if I look at it and go, yeah, private equity group's not going to be interested in this. It's too small. And it's for sale for, let's just say, $2 million.
They're trying to steal it.
Yeah, and I'm pricing it off. In that case, I'm pricing it off of discretionary earnings, and we're including and not including certain things in the transaction, like the seller's going to be keeping the cash, the accounts receivable, things like that. And then this person's coming down from, living in the private equity group world, doing 50, 60, $80 million deals, and they're coming down and going, no, working capital should be included in the price. I want this, I want that. And I'm like, well, we can do that. We're just going to adjust the price. Yeah. Well, what do you mean? That's not fair. And I'm like, well,
it's the levers.
We're pulling the levers, And I have these conversations. I go, you might be great in your world, and I think it's great that you want to acquire a business. But now you're playing in my world, and this is how my world works, and this is how it's set up.
Jim, additionally, from people coming down from like being in the private equity space and then trying to buy the business, there's something I can't stand. It's the person who's trying to represent themselves as a private equity group.
Oh my goodness, you see this all the time. Yeah, go ahead.
Some of them are upfront. They go, look, I'm an entrepreneur. I'm trying to buy a business. They're not trying to be something that they're not. The other people are claiming to be this private equity group It might be two kids that are still in college, but they're studying analytics or something. And you go, what's your portfolio? What type of businesses have you bought before? They haven't. They have no experience. They're just trying to structure a deal, take advantage of somebody that has a Main Street business, buy it at a discount, and get a deal. And they try to present themselves as something that they're not. So it's frustrating to me when you get these knocks at the door of people that are requesting information, and you go through having them sign a confidentiality agreement, and you ask for them to showcase their portfolio, because what we do when we qualify buyers is we're saying, can you demonstrate your financial capacity to make this acquisition? Show us your personal financial statement, your proof of funds, or a bank letter. With private equity, you don't really do that. A large private equity group is not going to be like, yeah, here's my balance sheet, here's what I'm working with, right? So if it's a fake PE group, or a group that's trying to represent themselves as a PE group, all you can say is, what have you bought in the past? What's in your portfolio? Yeah. They don't have anything.
Right. I don't know what's going on with this. It seems like it's
happening a lot.
It's a trend that's been happening, increasing over the years, where I think, and I guess I'm going to talk to a buyer out there. If you're looking to buy a business, like the buyers are coming along, and like Carey said, they're trying to represent themselves as a private equity group. They're trying to make themselves look bigger. They set up a website, and they have a corporation name, and they set up a website, and they make it seem like they're running some kind of private equity group. And they think, I guess, that at the end of the day, business owners and intermediaries will take them more serious. Well, first of all, we find out very, very quickly they're not the real thing, and in that case, they've lost all credibility with us. But number two, a lot of times, especially if you're looking to buy a business for $1 million, $2 million, $3 million, even 4 or 5, it's a turnoff to the business owner. It really is. And for some reason, the buyers think when they're creating that fake private equity group type situation that they're giving themselves some kind of advantage. But my experience working with business owners, they look at that and they go, I would rather have an individual, because I want somebody who's going to come in here and be an owner-operator.
Great point.
I want to know their personality. I want somebody who's going to be taking over my baby. I'm not some faceless company. And these type of buyers and I'm not slamming private equity groups at all. I mean, there is a place for private equity groups. I'm just saying the seller's mentality sometimes, that's counterproductive what you're doing as a buyer if you're doing that type of a situation. It's a really
good perspective and good point. I appreciate that one. Some of the other differences, just to run through them, due diligence, the process of due diligence in a Main Street transaction is a little bit simplified comparatively speaking. So a lot of times the buyer buying a business is the one doing most of the due diligence. They may loop in their CPA
and hopefully they're looping in their CPA.
Hopefully. There's a lot of times where I see people do it themselves. I always advise a person buying or a person selling to utilize the professionals that have either helped you buy your business or coach you in your career.
And one step further than a CPA, get an accountant or a CPA that specializes in doing due diligence. They know how to do the due diligence process. I think that's key as well. And they also have an attorney. And again, you should have an M&A attorney involved in the transaction, not just a regular business attorney. But go ahead, talk a little about the M&A.
Main Street, you're looking at a couple years of financials. You're reviewing some leases. You're reviewing some equipment. It's
tax returns, bank statements, merchant service statements, financial information,
POS,
things like that. I mean, you're digging pretty deep.
But now you're going to dive into an M&A transaction. You have financial analysts. You have really deep international maybe, but very advanced tax professionals that are involved, consultants that are involved.
Industry consultants.
Yep. So, for example, quality of earnings. You don't really see them in Main Street transactions as much. You almost always see them in a M&A deal, and a quality of earnings sometimes can be $40, $50, $60K, $1,000 to do the due diligence without the guarantee that you're even going to buy the business.
Right. So an individual buyer usually is not going to spend $50, $60, $70,000 on a quality of earnings or Q of E report. But if you're buying a business for $40, $50 million, even $15, $20 million, it might be money worth spent. Where the due diligence, you should on a Main Street, you're hiring somebody that specializes in due diligence, but the quality of earnings is just like another step up.
Yeah. The balance sheet as a financial instrument should always be looked at, but I would say the balance sheet sometimes takes priority in an M&A deal. Over an income statement. There's a lot of different things that change from deal size and whether you're taking a due diligence process that is applicable to an M&A transaction versus an
the due diligence process itself in a M&A transaction is a lot longer typically
Yeah.
than the due diligence period in a Main Street transaction.
And it's logical, right? Because if the business
You
is
got a lot
bigger,
more
there's more
moving
to look
parts.
at.
Yeah, it's bigger. There's more complexities. The business is more complex. The transaction itself is more complex, and you got more advisors, sitting there sifting through things.
From a legal and contract standpoint, when you're doing a Main Street transaction, it's typically an asset purchase agreement that you see most of the time, an APA as we call it. And then, when you get into M&A deals, they almost always start with an IOI, an indication of interest, knock, knock, I'd like to learn a little bit more, a letter of intent, an LOI.
And then down the road,
and that moves into a contract
down the road.
Right.
And you're talking about, might be an auction sale, which I don't really want to get in detail here, but the intermediary might be setting up more of an auction type sale.
Yep, we're coming to market, submit your IOIs.
Yeah, here's all the information in a secure file, and everybody gets the same information as they go through that process.
Let us know where you're at.
As they do the IOI, they get a certain amount of information, and then move through to give more and more information. But there is a big difference, and like in the Upper Main Street, we deal with both APAs and LOIs.
That's right.
And so sometimes it depends on what that transaction looks like, whether it should be an APA or an LOI. If it's and again, you always have to consult your attorney. We're not legal advisors. We're not financial advisors. You should always, consult the necessary people. But, an LOI is going to be more if there's more complex business or there's more complex type situations that need to be addressed up front. If it's a more simple, straightforward business, an APA may be fine, a standard APA.
Another difference, too, is maybe the way that you divulge pricing. Like in M&A transactions,
that's a great point.
You're typically not coming to market saying this business is listed for sale at X.
Right.
Right? It's here's all the information, place an offer. Whereas, and I think with the business brokers of Florida, which we belong to, businesses $5 million and below. Mm-hmm. Is that the threshold?
For what?
That need to be listed with their
any business
price,
under
right?
$5 million has to be put in this.
So maybe that should be the number that we're using for a threshold. But most of the businesses that are in the more Main Street or Upper Main Street, we do have a listing price. We may not always list the business and advertise the price, but I think more times than not in regular Main Street transactions, if not all the time.
Yeah, in the M&A world, the buyers in the M&A world, they're used to seeing an undisclosed or asking price, a price that's not being listed. And the concept behind that is, hey, here's the business, let's bring in as many different types of M&A type buyers wherever they're coming from and put offers in and get the best price. Where in the Main Street and the Upper Main Street world, you have to attach an asking price to that, because those type of buyers, if you have an undisclosed asking price, those type of buyers are just going to not knock on the door and say, want more information. And I think a large part of that is there's a big problem, because most businesses for sale out there in the Main Street and Upper Main Street world are way overpriced.
Oh yeah.
In the Main Street and Upper Main Street world, 80-90% of businesses for sale don't sell. Only 10 to 20% do sell. And a lot of them don't sell because they're overpriced. And buyers know they're overpriced. Buyers won't even hit on the business, won't even ask for more information in the Main Street and Upper Main Street world if there's not a price listed. So.
Let's hit on one last difference between Main Street M&A transactions, post-closing integration. Mm-hmm. Right? So we discussed this earlier, in a Main Street business, typically, there's, or I think it might have been another episode, but it's typically 2 weeks of training included in a sale.
In a very small business or a month or a simple, straightforward business.
Yeah.
In most of the businesses I sell, it's usually a month that's included in the asking price.
And there may be times where that said seller is asked to stay on for another
couple months at a fair market salary or consulting basis or whatever it is.
And you're really like the biggest focus is, aside from some general operational stuff, it's customer relationships. That's like one of the biggest things is transferring that relationship. When you get into the M&A space, the integration becomes corporate culture, systems and technologies.
Yeah, technologies.
It's typically a bigger business being sold, so there's more complexities, and a lot of that information rests with either the CEO of the business that's getting acquired or some of his C-suite or higher level employees. So there's a lot more integration work that needs to go between especially if the company's operating in the same space, right? If it's a large company buying a smaller company, they're typically, assuming they're in the same industry, they're probably running different processes. They're probably running different systems.
They have to transfer that. They have to transfer those processes over to the bigger businesses acquiring them.
It takes 6 months.
You know,
it take a year.
you got to integrate that culture aspect. You know, maybe now they're offering health plans and things like that to the employees. So you know they've got to set all that up. There's just a lot more complexities in that type of a situation than in an M&A transaction. The buyers, because they're investors, you know, I'm going to back up. In a Main Street or Upper Main Street transaction, the buyers are usually saying, you know, how long are you going to be willing to stay on post closing? You know, even if it is fair market salary, would you be willing to be on a consulting basis for a couple months after that? And they're looking how long will you be training me so I can understand the business? Where in a M&A transaction, the buyers are more looking at it as how long are you willing to work at the business, or do you have somebody underneath of you that can do your role? You know,
because we're not going to.
Because we're not going to. You're not going to train us.
Yeah.
We're going to, you know.
I really like that illustration example. And that, again, it's, to summarize everything, it is the size of the business, because the larger the business gets, the more complex it is. But it's who's buying it and what are they planning to do with it afterwards.
Yeah.
That's really the biggest difference.
And that's what we're trying to determine. We're looking at a business as who's most likely going to be buying this business. So obviously, we're not shutting the doors to anybody, because you always want to. You never know. I mean, it might be a business that would sell for $1.5 million, and you're thinking, hey, private equity group wouldn't be interested in this, but for some reason might be a private equity group that goes, hey, yeah, I like this as an add-on for some reason, we don't close the doors, but it's who is most likely to be the buyer for that business is kind of how we determine which way we're going to go with that transaction.
What we should do is, because at Boss Group or Main Street M&A, we do some lower to middle market deals. One of our other episodes, we should bring somebody on who's very accomplished in M&A and uncover some of the things that maybe we haven't even experienced.
Yeah, fantastic.
That would be great.
Yeah, that'd be great.
But this was a great introduction to the difference between Main Street and M&A. Hopefully, you as business owners that are listening to this understand where you might fit in, and as buyers understand that the process is going to be very different. We really appreciate you tuning in and listening to Boss Talk.
Thank you very much.